All right. Good morning, everybody. It's going to be a pretty quiet morning when it comes to things on the economic calendar. We do have some speakers today, European Central Bank, Bank of England, and then the U.S. Fed. So keep your eye on for that. Netflix is going to report today after the market. Who reports and when they report becomes important. Yesterday was a perfect example of how one single name can take a market. Right? Apple, with that news yesterday, took us into a tailspin. Different indexes are calculated differently. Kind of makes sense. So the Dow, for an example, is calculated differently than the NASDAQ is calculated. The NASDAQ, it can be driven by the biggest names in market cap. So a company with a big market cap has more influence than a company with a small market cap, for an example. So if we were to look at the NASDAQ and look at the biggest names in the list, that would be Apple. Apple is, for an example, 4 times bigger by market cap than Facebook. Right? So if Apple falls out of bed, so does the NASDAQ. Right? And while Netflix, is a fraction of the size, it is going to report today, and it's worth recognizing that it could have some ancillary impact, especially if you think about the sector that it belongs to and how it might impact its peers. And then you start adding up that market cap between, all of its peers. The cyan line here on the screen, that's when I posted the Apple news in the chat. You can see there's plenty of room left. We always get that question about where to get news and how things like this, the financial juice that we use in the mornings, tends to be a little slow. It's what I've heard as a complaint from other people. If you're using free news or free tools or free information, you kind of get what you pay for. All right. So if you think that you need some hair trigger on the draw fastest news source out there, as if you're actually going to do something with that information, you're probably going to want to go buy it. Right? Otherwise, take free with a grain of salt. It's a very quiet economic day right now. The thing that may be of concern is we're going to go into quiet mode soon, and all of the different Fed speakers may want to come out and get something off their chest or have their last little moment in the sun. And so we definitely want to be cautious of that. They can pop up on news sources without being scheduled. Right. So that's an important takeaway. All right. So as usual, there's only 3 things that we can do. Stay range bound, break to the upside, break to the downside. All of yesterday's price action is our range for today. The base case argument is that we'll maintain inside that range. And like we've done before, one thing that you could focus on is breaking that range down into quadrants based on institutional or universal pivot points. Things like yesterday's high, the Globex low, the open, all of those would offer insight and trade opportunities. This really is the most anticipated of the three choices we have on the table. Now, I named today's morning briefing coming back to the mean because while we did have that knee-jerk reaction yesterday to Apple's news, a lot of names out there are already pulling back towards the center again. So let's take the argument one step farther. If we don't stay range bound, where are we headed? A downside move, we would first need to get through our own Globex, the Globex open from last night, then through the lowest of our session, which, you got to admit they're kind of close together. So maybe they're close enough that marking both really isn't worth it. You're talking about a 4-point difference. Then the low of yesterday, and then the half ADR 37.96 and a full ADR 37.54. You want to split those two. There is a Globex low from, say, Friday. And below the full ADR, there's Thursday's low. So as you can see, if we start to space those out a little bit, we do have institutional or universal pivot points to the downside. Pretty uniform, really. We've got Friday's Globex high. If you discount that spike we had for Econ right before the open, that'd be 38.11, a cog line. So we would mark it because it was a cog line, or we could mark it because it was that Globex high. Either one would be fine, right? It's just being able to say the word and. It's a cog line and it was Friday's Globex high. The other argument would be that we actually break to the upside. So we're getting kind of close to a half ADR. That'd be 38.80. Beyond that, we could focus on yesterday's high, 39.09. And beyond that, I mean, you're really close to a cog line right there, by the way. So 39.11, 39.09. And then you've got your full ADR, which happens to line up with the 50-period daily moving average. If we go out to a daily chart, we're talking about this a daily moving average plotted on the intraday chart, right? So that orange line there, you can see how it lines right up with our ADR for today. That move yesterday, by the way, didn't really move us very far. If we're keeping track of how far away from the 10-period daily moving average, we're barely 0.5% away. So we're not overbought, we're not oversold, we're very close to the mean, very close to the center. We're basically standing in the middle of the basketball court, ready to make a direction either way. The ADR today is 2.18%. That would be considered normal, right? So a move up to that 50-period moving average today would be just considered an average normal move. We're talking about getting up to around 39.25-ish. Now, if that's normal, we absolutely want to consider what would one of those rip your face off rally days look like, right? So we would just add another 1% to this. Instead of a 2.1, we'd look at a 3.1, right? So with that in mind, from the ADR line be the quickest way to do it. Just add another 1%. You're looking at 39.65-ish, right? There's no reason to quabble over a few ticks. So 39.65 would be the upside extreme. You could do the same argument to the downside. Still, the most likely outcome for today is a range day, right? Especially when we start to broaden our perspective out a little bit more and we look at the bigger picture. 39.20, 39.30, right around in there. It gets us back up to this previous level, and we're just looking at this big box. All right, so here's a 10-day, 30-minute chart. It's got a TPO and a volume profile. TPO is in blue, volume profile is in green. We're very close to the point of control. And if we are going to make a topside move, 3,900 is showing a lot of volume right in that zone. So there's going to be a bit of a struggle to get through there. Now, the nice thing is the volume profile turned very shallow. So if we can get above our current Globex high, we're in a shallow zone up to 39. Generally speaking, we tend to move through those shallow zones easier than we do through a zone with a high volume. In that drop to the downside, 38.29. It's not a massive amount of volume, but there was some volume down there. We put in some more. And should we make another move in that direction again, it's likely that that volume may slow it down a little bit. Just remember that these aren't solid levels of like support and resistance. We wouldn't lean on them. We wouldn't trust them that way. We are basically in the center of the box. When we're at the box, we expect to go to the bottom. When we're at the bottom of the box, we expect to go to the top. We're kind of sitting in the middle near the point of control. So, with that in mind, we basically could go either direction. The TPO point of control is underneath us at 39.30-ish. We do have an untouched point of control to the upside, 3,900. You could carry the value area high from that same one, but like we've talked about before, I'd rather just carry the high of the day. They're so close together today that I don't think it would really matter one way or another. If you look at today's volume profile, we've certainly built up a significant level of volume here at this 38.70, 38.65 area, even though we haven't been there very long. What I just loaded is a TPO, and I set it to today. So it's basically reading what we've done since we opened in the Globex last night. Think of it as time by price. How long have we spent at a particular period on the chart, right? So you can see where that yellow line is, 38.66. We've got a significant level of volume there, but we really didn't spend very much time there. It's a good way to be able to quantify and evaluate, was there a large amount of liquidity in that zone? Say if we had come up into the top and we found a massive volume spike right there, uh, but not a massive time spike right there. It would show we spent a very small amount of time, and yet there was a very large amount of volume, right? Putting these two pieces together oftentimes can help us identify, was there, say, a significant amount of volume down at these lows? Because if we see a large amount of volume down there and we spent like no time down there at all, then we know that we landed in an iceberg or hit a ceiling or something like that. Different ways to evaluate liquidity, right? Keep in mind that Thinkorswim has a free book map. Yesterday, for an example, when Apple was going to the downside nicely, like it was, um, Apple is one of the names in that free book map. So I brought it up, was taking a look at it. It was a really great picture of the liquidity and how it was changing and adapting through that move yesterday. It certainly made trading in the futures just a little bit easier, right? Because I have just a little bit more conviction about what was going on. It, if Apple was to bounce yesterday, it very likely would have caused the rest of the indexes to start to bounce. So, just using Apple as an indicator to help trade another product worked out pretty good. Take advantage of those kind of tools when you can, right? It's free. I like free. All right, so we had some pretty exaggerated moves yesterday in Bitcoin, but we have settled back down, basically resting right at VWAP. The bonds sold back off again. We are above the lows of yesterday, sitting inside day, and we're underneath that 4-period daily moving average. But that's about all we can say on the bonds, except we want to see them hold this range, right? We don't really want them dropping more to the downside. Certainly don't want to see them running back up again. Dollar continues to sell off. It'd be nice to see this thing get back below that 105 benchmark that we've been using. Keep in mind that you know, a, a rise in the dollar index in the Dixie is still going to be a negative weight or a negative pressure against the S&P and the NASDAQ. So when you see the dollar making runs to the upside, anticipate that that's negative against the market. It is worth noting this morning that we're very compressed in the dollar. This thing is getting ready to make one hell of a move. And the VIX is actually more responsive to our immediate situation than the dollar is. And that hasn't been true for weeks and weeks. So it's just a little oddity that stands out. Definitely keep your eye on that dollar. It's getting ready to make a move, right? There's no promise made when we see a compression. We just know that compression equals energy, and energy is very likely to be burned, right? It's going to burn that energy and make a move. The VIX did just drop back below 25 and rally up to it again. Keep your eye on this thing. It's been mostly worthless through the year, right? And so many times this thing has provided value and insight. It just not this year, right? And of course, it's nothing more than a formula. It's monitoring the trading activity within the SPX. That's what the VIX is all about, right? The VIX. And this is the VIX futures, but still, if we were looking at the VIX, the VIX, it's nothing more than options traded in the SPX 30 days to expiration. When we look at things like skew, the VVIX, which would be like implied volatility of the VIX, and we look at the VIX itself, it's really been highlighting a lack of hedging, right? People aren't buying puts in, say, the SPX, and they're not buying calls in the VIX, because if they were, we would see that, right? It would be reflected in the VIX and in the skew. There's often the phrase that you don't have to hedge against a market downturn if most of your positions are for a downturn, right? If you're positioned for a short in the market anyways, then and you're overly short, right? Net SPY deltas happen to be negative, then your risk is actually to the upside, not the downside. The same perspective we carry with the dollar, we also carry with oil, energy. Want to see oil stay below that $100 benchmark. If we get above it or start to challenge that $100 again, look at that as a negative pressure against the S&P and the NASDAQ today, especially on a day like today, right? We don't have a lot of econ, but what we do have are these three markets: the energy market, the bond market, and the dollar index. And these three can and will put pressure on our market, right? So if you want to see one of those beautiful, amazing, awesome trend days with a great rally in it, we need these markets to not put a lot of negative influence on us. So you start to see these wake up, start to make big moves, then adjust your positions accordingly. All right, we're a little short in natural gas this morning. Looks like the marijuana sector is down a little bit too. And USO, you can maybe make the argument for industrials, but it's right at the line. A benchmark would be 0.5%, right? When we're gauging what's moved around in the pre-market, that 0.5% is a good line in the sand. Uh, Precious metals like gold is up this morning. Emerging markets, we tend to use this as a uh, risk on for global market sentiment. So when we see that bid up, it's one more check mark in the we could have a bullish day column. And the Bitcoin ETF is up this morning more than 2%. It's looking pretty good. So these legacy old school 11 sectors, they really kind of leave out things that are a little more nuanced, right? Like the crypto names, the crypto sector. So when we delve a little deeper, we want to look at the names that are up in that crypto list. We can see BITO, the crypto ETF is up. But is it more that crypto coins are up, or is it more about blockchain names that are up? And if we bring up the crypto list, we can see PayPal, Nvidia, AMD, Taiwan Semiconductors. So chips are looking really good this morning. Another sector that is kind of underrepresented, if we're trying to use those old school 11 sectors, is the EV market. Kind of break that down a little bit. When I look at this EV market, the list that we have here, instinctively I focus on names that are more understood to me, right? Like Ford, GM, these names that have been around throughout my entire life. Of course, they're new to the EV markets compared to, say, something like NIO, Li Auto, Ride, Tesla, Rivian, companies that were solely focused on EVs. So to me, I kind of try to break them down into, legacy, old school, regular markets that are getting into the EVs versus the EV markets. Still, they all get lumped into the same category. It is worth kind of looking a little bit deeper when you dig into things like the EV, because there's also like navigation, batteries. I mean, every sector out there, you can break it down into smaller and smaller and smaller sectors, industries within those sectors. The EVs are looking pretty good this morning. Even the legacy names like Ford and GM. Tesla's not dominating the list by any means, but at least it is up this morning more than 1%. Again, it comes back to market cap, right? Tesla's big enough to drive order flow in the market. And when we're focused on names that don't necessarily move with the rest of the market, say a negative beta or just a really low beta, the pot stocks make a good focus. And they're up this morning. So most of the market right now is building this base along the lows, right? We got Tesla on the screen right now, and it's a pretty decent representation of what's going on out there. Got a lot of markets kind of forming this same consolidation along the lows. Keep in mind, we've got a long way to go. We got a lot of markets that are still needing to report earnings. And the Fed is still not going to want to see these markets rally back up again. They're very likely not going to let it do that. Right. So this whole idea that the bottom is in and that we're going to finally come up off of these lows and revisit all-time highs, I'm not the one to say that we can't do that, right? We've learned by now we don't want to say things like the market can't do something. But with everything on the table and knowing that they still haven't destroyed earnings the way that they've destroyed everything else at this point, means that we're very likely not done with the lows. And if you go to look at something like Apple or SPY, use, and you start asking about what's more likely, which is the way we want to approach a lot of things on a day-to-day basis. From where we sit right now, you got to be able to ask that question, what's more likely that we see 340 back to where the market was before the COVID drop first, or that we see 440? I think that's a pretty fair argument since we're sitting right at that 381. So we're looking at, pretty much the midpoint between these two. What's more likely and where's the greater risk? That we see 440 first or that we see 340 first? And with that in mind, you really want to think about how you're positioning, right? Everybody that feels like they missed this run and they're promising themselves that they're not going to miss the next one, continue trying to buy in along these lows, thinking that, the low is in. I'm sure they thought the low was in there too, and that it was in there as well. We're not done yet, right? The really great thing is in today's world, you can sustain shorts all the way through a move to the upside like this, and you can sustain longs all the way down through a move like this, right? Not only sustain them, but actually benefit and grow and widen your account out while you do it. Thanks to options. Have a good morning, everybody. I'll see y'all tomorrow.